I want to start off this whole conversation with, I want everyone to recognize that there really are multiple stages of this event, of being the survivor of a relationship and having to put together the pieces in a way that fits your life. The very first stage is the one that I think is too quickly glossed over. It's the stage where really you're grieving. I listened to a really great podcast of an investment advisor who specializes in this, and she uses that word grieving, the grieving stage, and it is a very important stage, and it's not a stage that has a set time limit. For every individual, it's of different length, and and that can come from there's multiple reasons why it has a different length. I mean, some people are married and a spouse is sick for a very long time, and they're caring for that spouse. They're going through a grieving process even while they're taking care of their spouse. And when their spouse finally passes, they're more quickly, it's all varies from person to person, but they're more quickly exiting the grieving stage and moving more into what I would describe as the planning stage, the decision stage, making changes to their life, evaluating the setup of their financial life. But there are other situations where it's a spontaneous death of a spouse, and it comes as a massive shock, and it requires a much lengthier grieving stage. And again, it varies from personality to personality. So there's no real set time limit, and I really want to make sure people focus on that, because the grieving stage is an important stage to sort of settle yourself. So there are two stages. The very first stage, this grieving stage, is a stage that I think is very touchy. It's important, as I've said, but it's a stage where you can make mistakes, and I think the importance of sort of settling yourself is pretty critical. So time, I always use icons whenever I talk. I don't try to use a lot of words. I want to use pictures, and I use concepts. So time there is in the bottom left of the screen. Like I said, there is no set time. So when you go through this, or if you have gone through this, just recognize that there is no clock on it. There's no shot clock, as they say in basketball. It can go on for quite a while. There are things that you have to take care of that Pam back there, as I went through this presentation, reminded me to utilize the word tasks. There are some things, the tasks, that you need to take care of, but they're not big decisions. They're not life-changing decisions. They're not altering the current setup. They're just simply tasks. So while you're going through a lengthy grieving situation, recognize that there will be a time, or in your case, if it's happened to you, where you had to deal with certain tasks. And sometimes it'll feel a little too quick for you. But tasks are part of the equation. The fact is, during this stage, there's a phrase in psychology, and I think is used in the investment world, investment advisory world more and more, is this idea of, and it's not the right gender-specific aspect of it, but it's sort of a widow's fog, a situation where you literally feel that you can't, your executive functioning skills are diminished. You're in grieving, you're in shock, you're just trying to get through your day. You have an inability to take a look at your life and make critical executive function kind of decisions. Moving accounts, hiring an advisor, interviewing a lawyer, dealing with some technical details. There's a period where you're just not capable of doing that, or you don't have the ability to do it. And I think people need to just recognize that that's going to happen. In preparation for this, I say it's smart to have a few trusted people in your life that can help you filter that information in the beginning and kind of hold it off until the time comes where you're going to exit this stage, because it eventually happens. You don't always stay in this stage where you feel that you can't operate in an executive way. So this fog happens, but during this fog, the one thing that I want to make sure people are aware of and they're really watching out for, or what I would kind of, it's a phrase again that I heard and I thought it was catchy, is this idea that there are wolves out there that want to take advantage of your situation. You know, I don't know how, there are people out there who sell things, sell based on fear. If you're in a mode where you're very, very insecure, you're susceptible to doing things that are, in some cases, financially very damaging. So, and I mean something like you'd buy an annuity, you put all your money in a CD, do whatever it is that you're doing, you're trying to lock down uncertainty because you're in an uncertain situation, and the wolves out there recognize that you're in that situation. So this is not a stage where you make big decisions. It's where you kind of calm yourself. You're going through a grieving situation. I'd say even for family members or advisors, people that you have looked to in your life, they may want you to move a little faster than you're capable of moving. Push back. It's totally okay. Nothing terrible will happen as long as you take care of some of the tasks that you have that are not really critical things in terms of long-term planning, but they're short-term critical. These tasks you can take care of. But I'd say even push back on loved ones and say it's not the right time for me to make that decision. So this is the stage where you're not making big decisions, but you're going to eventually get through it. And I've not lived it personally, and I can sound like I have some deep, intimate knowledge of this. At my young age of 46, I have not gone through this situation, but I do know that everything passes. You know, this too shall pass. Well, this stage does pass eventually. And you can move on to what I would describe as managing the decision stage. In the decision stage, I want to kind of paint for you a continuum of a categorical continuum of tasks that need to be taken care of relatively quickly. Tasks that need to be taken care of, but really just soonish. They're not tomorrow. They're not next week. They're things that you can push off until you're ready for it. And then there's that third category that kind of is along that spectrum of decisions that are big. And examples of big would be selling your house, downsizing, hiring a new advisor, buying a large annuity. These are some things that you really need to have all of your wits about you. You have to have all the information, and you have to have all the knowledge to be able to make those kinds of decisions. So along that spectrum, short-term tasks, things that you can take care of relatively soon at some point in the relative near future, but don't have to do it today, all the way to things that you can put off until you're ready to make decisions that matter. But any good, thoughtful, rational person recognizes that there is a prioritization that happens in life, and you eventually move towards the big decisions, because the big decisions are where you really create your life and where you've created your life. So managing the decision stage, I would say that as an umbrella statement, it's important for you prior to this situation. So some of you may already be in it. Some of you are anticipating it and preparing for it. Prior to losing a spouse, having trusted advisors in your life is pretty important. I'd say it's more than pretty important. I think it's very important. That the three big advisors in everybody's financial life are their accountant, CPA, tax preparer, someone who actually provides them some advice on taxes. And that person can also provide counsel when it comes to other aspects of your financial life too. I mean, I know a lot of CPAs who are providing tax preparation services, but they're much more advisors than they are just cookie-cutter tax preparers. And so one advisor in your life is your tax person. Another advisor in your life is your estate planning attorney. And I do programs on estate planning where I have speakers do programs on estate planning. Estate planning is a core signature program of the Money Series. And having a good estate planning attorney is important. And they will help you through a lot of the administrative tasks following the death of a spouse. And they'll prepare your family for your eventual death and do it the way that you've laid out. So having a good estate planning attorney is critical. And then the third one, of course, is the creature that I am, which is an investment advisor or a financial planner. These are all the phrases: financial planner, financial advisor, investment advisor, wealth manager. Our industry tends to like to make up a lot of different titles. But in the end, it's the person who really is a quarterback, a central person in your life when it comes to your investment accounts. Really is helping to coordinate between your estate planning attorney and your tax specialist. Someone who is helping you make those big decisions that have financial impact in your life. And finding trusted advisors in all these areas, I think, will help you handle the next stage. Now, let me kind of preface this whole thing with saying that oftentimes, and I have this in my business, my practice with my clients, there are couples where everyone has a different dynamic, but couples where one of the members of the husband-wife team, and it's not always a man, it's not always a woman, are the lead in the relationship with me. They tend to be the one that's most interested. They tend to be the one that asks the most questions. They tend to be the one that would show up for a meeting when they're asked to come in for a meeting, or the requesting the meeting. And I heard a statistic on this, that a widow, in the case of the female, the wife surviving, 70%, it was a shocking number, 70% of widows replace their investment advisor within 1 year of becoming the sole relationship person in that advisor-client relationship. 70% within a year. Now, you know, the anecdotal stories when I heard this statistic were shocking and embarrassing. Where the advisor, when they pull in that surviving spouse that they've not developed a relationship with, they've been focused purely on the other spouse, the one who's passed away, they finally pull them in for a meeting, and the meeting, of course, goes terribly wrong. At a time when the surviving spouse, who hasn't been as tuned in on the financial side, begins to talk, the advisor's completely off focus, talking about investment returns and asset allocation and things that I'll talk about later on. But that is not the stage that they're in when they're just trying to become acquainted with the advisor. The fact that they're becoming acquainted just following the death of their spouse within a relationship that's already been pre-existing, no wonder they're fired within a year. So they've just not done the development of the relationship that they have to do. And so I'd say, as a preemptive thing, if you are in a dynamic where one of the two of you is the focal point of the relationship, work against that and fight against that. It's because very likely you, if you're not the one involved, it's because you don't want to be involved necessarily. We all divide and conquer within our households. I do the same thing within my family. And so my wife becomes an expert in everything, mostly everything. And then there's me. And that's kind of the way it works. Well, you know, I can replace a doorknob, but that's about all I can do. So you have to make sure that you force yourself into an area that's sort of somewhat uncomfortable. And if financial management and talking about money and learning about investments and all of that is something that you're shying away from, force yourself before the event happens. Force yourself to become more acquainted. You don't have to operate in the minutia, but you should operate at a level that you've gained enough comfort with the advisor so that they're able to help you as a trusted advisor in the next stage. That you're not actually trying to overcome what I would describe as a relationship deficit right off the bat, because who wants to have to fill that deficit at a time when you're most in need? That's frankly the situation, and that goes for every single one of these advisors. So this concept of the big three will help you over the next set of slides as I talk about some of the specifics that you will have to deal with over time, again, within the spectrum of those tasks that have that hierarchy of, yeah, you have to take care of it, it's a task. I don't really need to do it right now, I can do it a little bit later. to maybe I really need to only do these big things when I'm totally ready. That spectrum, these people can help you move through that more quickly and more confidently. That's my view. So moving into the very first set of steps or tasks following the death of a spouse is that you're going to be dealing with a funeral, a memorial, that whole process. And we've all been through it. We've all seen it. It's a very stressful time. It's full of emotion. It's wonderful if it's somewhat been pre-planned. And so I've thought about Money Series topics where we actually talk about pre-planning of your funeral and bringing in people from funeral homes who specialize in this, because I think that it's a lovely thing when those details that you otherwise have to be dealing with right after the death of a spouse have already been planned out. But one of the things that this stage allows for is that oftentimes a funeral home, your contact at the funeral home understands the basic minutia that does need to be done in terms of, well, death certificates, for example, getting copies of that, and instructing you on how to get more copies. Because frankly, as you go through the settlement of the estate, as you change over the titles on accounts that need to be changed over or may need to be changed over, you've got the tool that allows that financial institution to switch the title of the account if that has to happen. So this often comes up where, I don't know, 10 to 15, I mean, I was talking to Pam, up to 15 of them might be a smart thing to have. So death certificates, we're talking about certified copies of death certificates. The funeral home director, the funeral home director, they know how to create this. They actually file the death notice, and they inform. Oftentimes they inform, and I think you should just double check it and triple check it, but they inform Social Security, for example, of the death of a spouse. So they're going through the formal steps for you, and they're guiding you through that paperwork where you probably, if it's done extraordinarily well, you don't even know it's happening. It's sort of happening behind the scenes. If you're signing off on things, it's happening pretty routine, like administratively. So contacting Social Security, which of course at that point can help trigger a death benefit. I don't know how many of you are aware that when a person dies, there is a small $255 death benefit that's paid. I'm not really sure how that number was ever decided on or when, because I think, and I don't know the specifics, the average cost of a funeral, I think it could be approaching $10,000 or more. I had some notes from Pam when she was giving me some tips on this. I think $10,000 might even be on the low side in some cases. So $255 is nothing really relative to that total, but it is $255, and Social Security benefit, a benefit is this death benefit. You should just be aware of it. And also the Social Security survivor benefit, I said earlier that I do a program on Social Security planning every year, and this is a pretty big element of Social Security. So really high level, when your spouse passes away, if they had a higher benefit than you have, and you may be earning a benefit based on your own work record, meaning your own work history, or you might be earning a benefit that's purely a spousal benefit, which is typically set at half of your spouse's benefit. You get whichever one's bigger. When they pass away, you step up into receiving your spouse's benefit as a survivor. So you become the survivor and you get their benefit for the rest of your life. You, of course, no longer get your own. So there is a decrease in your family income. But that process of stepping into, as a survivor, into that benefit is something that Social Security will do, in many cases, automatically. If you're already filed and you're already collecting benefits based on some level of spousal benefits, you'll then have a stepped-up survivor benefit. But being aware of this, making sure of it, these are some administrative tasks, and really setting up a meeting with the Social Security system and just double-checking all of that. It's a pretty important task. Does it have to be done instantaneously? No. But it's one of those basic first things to think about, because it is an element of a large number of people. It's a large element of their income. So later on this spring, I will be doing a program on Social Security with a lot more detail on that. So moving on from the funeral aspect and dealing with Social Security and the death certificates, this task here is enveloped under the concept of gathering, organizing. And I don't want to make you think that, you are immediately going into this organizational stage. Again, we're going through grieving, but within that, some of the basic things you can start to do are collecting and reviewing your current and old mail. That envelope, so let's talk about the old mail. That envelope that's sitting inside the dresser that you haven't opened up in a long, long time, and you open up that file cabinet, and there's an envelope from an insurance company you've never heard of. And you look at the date, and it's relatively recent, and you are not the person handling all the finances. There's a clue that you might have a life insurance policy. So being aware of those envelopes, where they've been stuffed away, if you're not super organized, making sure that you collect all that mail, incoming mail, premium payments that need to be made. All of a sudden, you're going to start to be able to gather up financial information that you may not have been fully cognizant of. This is just a gathering stage. This is a beginning the organizational stage. So reviewing current and old mail, reviewing bill payments and subscriptions, looking at your credit card statement, seeing what those recurring things are. Like, I didn't realize we were subscribing to Outdoor magazine that I no longer read. So those are things that are recurring billing that's happening. These are the things you want to look at on your bank statements, on your credit cards, looking for those clues to your financial life that you may not have been fully aware of. Reviewing your income sources, just having an understanding of where your money is coming from. Pension payments. Remembering that your spouse worked at an old corporation and may actually be getting a pension that you didn't know about. I mean, I don't mean to stress the cluelessness that you may or may not exhibit, but there are situations where that it really was driven by the spouse that's now deceased. They know all those details, and you never really wanted to get into those details. You just lived your life and did all the other tasks in life that mattered. Grabbing current statements and having those current statements and beginning to put those in the right piles, because eventually you're going to move to a stage where you're working on those really longer term plans, and that's where you're going to say, okay, I know what I'm currently invested in. I know what money I have in this institution, and I know how many different institutions I have money in. And so collecting those current statements. This is sort of that organizational stage. Estate planning documents. That's something that comes up with even the most organized people. They've lost track of their estate planning documents. They remember that I think we did a durable power of attorney for health care. I think we did, I think we have wills, but I don't remember where they are. Gathering those up, looking in the file, and keeping that readily accessible, because there will be a time in the not too distant future where you're going to want to revise some things. So gathering up information. This is the gathering stage. Now, moving into the tax piece of the picture, there are a couple things that I just want to highlight that some people are not aware of. When someone passes away and they held an asset that went up in value over time, the original price that you paid is called the cost basis. So the government cares that you invested here and it's now worth here, and when you sell it here, this gain is taxed. It's called a capital gain. So the cost basis is what you originally paid for something, and they want you to keep track of that. The government does. So when a person passes away and they own that asset, and they passed away without selling it, the cost basis rises to the current value. In other words, there's no more gain on the books. The government no longer will collect any capital gains tax on it from that point forward. So that's called stepping up. So being aware of the fact that assets step up upon the death of your spouse is a pretty important thing to be aware of. And it can happen automatically behind the scenes, semi-automatically. I mean, I don't think anyone should ever trust that things happen purely automatically. So just being aware of it, having someone that you can talk to, an advisor about these topics, asking the questions, having them fill in the gaps for you is important. But having the awareness, I think, is the key to always, to getting things that you deserve. So this stepped-up basis is important to be aware of. The automatic nature of it is if you have money at a Charles Schwab or a Fidelity or a Vanguard, and you inform via the broker or the investment advisor or the financial advisor, or directly you inform the brokerage firm themselves that your spouse has passed away on such and such a date, they will then step up the cost basis themselves for you. And the government actually is required now, they've required brokerage firms to keep track of the cost basis for assets that were purchased after 2011. Before 2011, the government said it's still an honor-based system. You tell us what you paid for it, and if we decide we want to audit you, we'll audit you, but otherwise we're going to trust you. After 2011, they said we're no longer trusting anybody. If you buy something, the government is going to keep track of it through mandating brokerage firms to keep track of it. So a little more detail than you wanted, but I want you to know that stepped-up basis is important, and it will save you taxes going forward to make sure that you've got that properly recorded. Your advisors know this, but if you don't work with an advisor or your advisor is not paying attention, you may not see that step-up happen. I'd say the next words are, consider. So this is definitely something that you do not have to do. It's not an immediate task. Might be something you could do kind of soonish. Could be something you do much later. But this idea of consolidating accounts. So I can tell you, professional experience, prospective clients come into my office and they've got accounts a lot of places. I mean, I don't know what drives that other than just momentum, inertia, whatever it is, where they open up an account here, they open up an account there, they had this relationship here, and pretty soon they've got 3 or 4 or 5 spots where they've got money spread all over the place. There's no consolidated view of what's going on. They've got an IRA here, an IRA there, they're both their IRA. Well, the fact is you can merge and consolidate accounts and have them in one single spot and get diversification and better understanding over the course of time. There are also reasons when you have a spouse that passes away, the spouse has an IRA and you have an IRA, the government allows for you to take over the IRA and merge it in with your own. And it becomes your IRA, and there are tax benefits to doing that, and it's something that's only afforded to spouses. So if you are named as the beneficiary and you're a spouse, well, it can become your IRA. If you're not the spouse and you inherit an IRA, it's never yours in your name. It's always an inherited IRA for the benefit of you from the deceased person. And the government has a completely different way of looking at it, and a different way of taxing it, and a different way of forcing money out over time to pay taxes on it. Very different than when you're a spouse. So a spousal situation where a spouse inherits or as a beneficiary of an IRA, it can become your own, and it can be much simpler to merge the accounts together. So there are lots of consolidation moves that you can make. And for me, I will tell you, it's a building block to understanding. The more accounts you have, the more confusing it is. The more confusing it is, the less likely you're going to make any kind of strategic decisions, because you're just trying to do what I would describe as the administration of your money. Not the management of your money, just administering it. I've got 5 different accounts. I keep track of it all. I try to remember what the performance looks like on all of them. I don't know exactly which one. Now, then you hit 70 and a half, and you've got 3 different IRAs and 3 different institutions, and you've got to take distributions out of 3 different places. You've got 3 different sets of tax forms happening. Now you've got to get that to your CPA. This does not allow for you to stop, breathe, plan, manage. So consolidation of accounts, to me, is a simplification maneuver. Considering tax planning moves, the only thing I want to say about this, to try to keep this not too technical, is that when you're married and you lose a spouse, that tax year, you get to file as married. Even if you were married for a day of the year. So you're now filing married. When you're filing married, especially in this world now where deductions, standard deductions, are really big now, bigger than they've ever been, you may actually have bigger deductions this year. If it happened to 2019, your spouse passed away, you may actually be in you're married, filing jointly, and you have a bigger deduction this year than you will in 2020. In 2020, you'll be single. Your deductions will get cut in half, presumably cut in half. And as a result, you may actually be in a situation where you pay higher taxes, depending on all your income sources, higher taxes next year than this year. So the smart thing to do is to say, wow, I'm in a lower tax bracket. I have bigger deductions. There may even have been medical expenses that happened this year where the spouse had big medical expenses, which are deductible, for example. Staying in a nursing home with extensive care in that final year. Well, then you want to think about how I can bring income on purpose into my tax return and pay less in taxes. And there are some ways in which you can do that. I know it sounds confusing, accelerating income into this year, but anyone who's owned a business understands that concept of showing income this year as opposed to showing it next year. A simple, similar concept is probably something that people have taken advantage of. Hey, should I pay my property tax bill now in December rather than paying it, in January? And sometimes as a taxpayer, it's better to pay it a little early and get that deduction than it is to pay in January and maybe miss out on that deduction. Very similar concept. Bringing income into your tax return is a way of saving taxes, especially in that very first year after the death of a spouse because of the married filing jointly situation. Be aware of required distributions. That's something that I've done a program only on required distributions. In fact, that first picture of slides, I don't know if you saw that 70.5 video image. Required distributions are the most punitive thing to mess up in your financial life. And if you're grieving, or you're not the one who's fully aware of what's been going on financially, or if you haven't developed a trusted advisor relationship where someone who actually follows the stuff and manages it for you, and there are a lot of people who don't have that, which is fine, you need to be aware that the government requires you to take money out after a certain age, magical age of 70.5. And just like the $255 death benefit, I do not understand how they picked 70.5 as the age. There is an actual reason, but I've heard it and then ignored it because it doesn't make any sense. So 70.5, you have to start taking out money out of your IRA and your tax-deferred accounts. And the only reason is the government wants tax revenue. They've let you put the money in without paying tax. They let it stay invested in presumably rising in value over your lifetime without paying tax. At some point, they want you to start taking money out, and they want you to start paying taxes on it. It's a pretty simple concept. If you miss the required distribution, you forget about it, or you under-distribute, you don't do the right number. It's based on a life expectancy calculation that's somewhat complex. It's a table. Brokerage firms will help you calculate that, and they'll start to calculate it going forward for you, so it's not that hard. That the missed amount, the penalty is 50% of that missed amount. And let me just kind of put these into, for some of you, you might roll your eyes and say, that's a great example, Jason, but okay, let's say you have built up $1 million IRA, and you're 70.5. The total amount you have to distribute in that very first year is $37,000. That's the required distribution. It's 1/27th of your life. That's what they're saying. That you're going to live for 27 more years. It's not. You're not actually going to necessarily live 27 years because that's at 97 years old. But there's a reason that they calculate it that way. That $37,000, if you don't do it, the penalty is $18,500. So there are ways in which, if you forget, there are ways in which you can ask for forgiveness. And it's not that there isn't, I'm not an enrolled agent with the IRS, so it's not like I've had personal experience with this ask for forgiveness thing. But I've heard that if you have some reasonable basis for having made a mistake, and I think losing a spouse, grieving, those are things that the IRS could look at and give you a little bit of a waiver on. But I wouldn't count on it. So being aware of RMDs, required minimum distributions, RMDs, is pretty important. Estimated tax payments. So having gone through this presentation with Pam, she cautioned me against, oh my gosh, you're going to talk about estimated tax payments when people are grieving. And the answer is yeah, I guess I am. And so not everybody has to pay estimated payments. Estimated payments basically means that you've calculated the prior year's tax liability. In April, you figure out, hey, I had to pay $20,000 of federal income tax. And then the government says, well, in order for you to be in compliance the next year, you need to set up quarterly payments to the government that looks a lot like last year. If you don't know what it's going to look like this year, at least you base it on what you paid last year. So the CPA will present to you a tax return for the previous year, and then they'll also give you little coupons, little slips that say, this is what you owe on June 15th, this is what you owe on September 15th, this is what you owe on January 15th of the following year. And it's your estimated payments. So there are tax payments that you just need to be aware of. If you're paying estimated payments along the year, or around the year, or throughout the year, and your spouse has been in charge of it, just be aware of, oh, well, I actually have to pay that. If you don't pay it, there are, again, interest and penalties that can apply. So in the state of Michigan is way more punitive than the IRS for the penalties. So you especially want to make sure you're paying your state estimated payments. If you're taking all of your taxes out of your IRA distributions, if that's where you're largely getting paid, or your pension payment, or other sources of income you're actually paying in withholding, you may never have to do estimated payments. It's when you have dividend income, interest income, you're not taking money out, withholding taxes from other sources, that's when you need to make sure that you're paying in at a rate quarter by quarter by quarter that satisfies the government's rules. And otherwise, that you'll be considered underpaying taxes along the way. They don't want you to just make all your money and then you pay it the following April. They want their revenue along the way. And it's your job to pay it along the way or have it withheld from your other income sources. So you either write a check or you have it withheld. Either way, it's coming out. So estimated tax payments is again, that's sort of like a task. Not going to apply to everybody. But you just need to be aware of the fact that it's been happening in your life, possibly behind the scenes, by your spouse. This one is all about estate planning. It's really quite short, but the biggest thing about it is the second bullet point. So making sure you review your estate planning documents. So you've lost a spouse. You had an entire estate plan built around the fact that both of you were alive. It might be that you've named each other trustees of each other's trusts, or you've got each other named as beneficiaries on all of your accounts, which is totally normal. You know, his and her. I have an account, she's the beneficiary. You know, I have an IRA, she's the beneficiary, or vice versa. When one of you is gone, the other person is going to be left having to make pretty big decisions. They're not, usually you have contingent beneficiaries built into your setup. But if you don't, you want to make sure you're reviewing your beneficiary designations. Because now all of a sudden you've got a fresh reset in your life. You get to decide at that point, how do I want my money to flow after I'm gone? One of the phrases from this podcast that I listened to it caught my ear was this concept of having my spouse dictate things from the grave. And it's really, maybe put in a little bit different way. You know, my spouse decided this or invested in that, and I would just feel really bad if I changed that because I feel like I'm sort of going against what my dear husband or dear wife wanted. You know, my view on that is just you need to push back against that over the course of time, because you are going through a new reset of your life when you're the survivor. You have to decide what's right for you, not what was once right for us. Okay? So updating and reviewing beneficiaries, I would say as a general rule, prior to any kind of an event where you've lost a spouse, this is something you should just do relatively routinely. I mean, most of the time your life is static. You know, I'm married. I named my spouse as the beneficiary. I've named my kids as the contingent beneficiaries. And every year that seems like it's okay. It's okay until something changes. Once something changes, you just have to have the wherewithal to be able to say, oh, I usually routinely look at this stuff, and I make new, fresh decisions about what we want. And that also goes into play with your estate planning documents. You may have named your spouse as the durable power of attorney for healthcare decisions, financial decisions. Well, when they're no longer around, you need to think through, who are my successor people? Who's going to help me if I'm in the hospital and incapable of making a decision? Who's going to be around physically to be able to help guide my care? You know, I once relied purely on my spouse. Now my spouse is gone. You just need to make sure you've got those estate planning documents refreshed in your life. Okay, now we're moving into some money stuff, and this will be a relatively quick overview. The first thing here I would say is reviewing your resources, which basically means the stuff you've got, the stuff that you own, the things that are going to create financing for your life, and your cash flow, which are things that are flowing into your life, income sources. Reviewing that at a very high level is important. If you don't know it and you're the spouse that survives, it's a pretty important first blush glance at your life. Seeking and demanding understanding. This one goes to the heart of the relationships of your trusted advisors. I alluded to it earlier, and I'll just quickly repeat it, is, you know, you have a right as the survivor in a relationship with an advisor to demand that you understand what's being said to you. That doesn't mean that it's their fault that they're not able to get the message across. It means that you're not speaking the same language. And if you're not speaking the same language, then you need to get on a different country. You need to have speaking the same language. If you can't ever come to that point where you're speaking the same language, then it's okay to move your advisor relationship somewhere else eventually. Again, there's no gun to your head to make that change. It just needs to be based on something real, which is I'm not getting what I need and understanding that I need. Don't think it's on you. Ultimately, you're the one being served. So demanding understanding. Doing an advisor review. I'm going to go through a couple bullet points on that, and doing a portfolio review. These are not things, if you look at that spectrum, tasks, things I can kind of do in relatively soonish, but I don't have anybody, you know, telling me I have to do it right away, to things that are pretty big. We're now moving into some pretty big things. Dealing with trusted advisors, looking at your portfolio, understanding your portfolio, making strategic decisions about your financial life. You're now moving way down the spectrum. This might be a year after you've lost a spouse. It might be 2 years. It might be 6 months. It might never happen where you're making these changes. But these are things that you don't have to do right away. So I want to stress that. I'll hold questions until right after, and then we're going to do a Q&A. So I'm going to run through these basic things, and I have mentioned a couple of these, so I'm going to skip communication because, to me, it's the top level, most important thing with anybody you're dealing with that's giving you advice is that you have to be communicating with them in a positive, helpful way. If they're failing at that, then the relationship is failing and it's not benefiting either party, frankly. When you're talking about an investment advisor, I'm going to kind of tell you what I think is important. And I think it's really important, frankly. So fiduciary duty, very, very quick. Having a legal fiduciary duty to your clients, to me, from a client's perspective, is critical. You want someone who has a duty to act in your best interest legally. That is not the case in the investment advisory world uniformly across the board. Period. There's fighting politically to actually impose a fiduciary duty that is as strong in one element of the industry relative to other sections of the industry. There's a fight that's been ongoing for my entire career, and I've been now in business, well, I've been in the investment business since the late 90s, 1999. And they've not been able to resolve the internal battle. Why? Because having a fiduciary duty does change the way in which advisors are going to conduct their business. Some advisors. Other advisors adhere to a legal fiduciary duty. I think it's important for you to make sure you're dealing with someone who has a legal fiduciary duty to act in your best interest at all times. Disclosing all conflicts of interest. Making sure that you are literally, figuratively I should say, sitting on the same side of the table. Okay? Fee only, it's the way in which they get paid. I have a strong belief in this, that it's not wrong to sell a product and get paid a commission. There are many industries where that's the way it works. We all know those industries. We've all been able to navigate that. Inherently, the situation of being sold a product in exchange for a commission does create a tug of war in the relationship, knowing whether you're getting exactly what you need or what it is that the salesperson wants to sell. When you're dealing with an advisor who's operating on a fee-only basis, they are getting paid a fee that you're paying them directly. There's no third party paying them. And they're not selling you a product, they're selling you a service. So fee only means that you're only paid by your clients. And I think it's an important principle for you and your relationship with your advisors. Experience goes without saying, but I'm going to say it anyway. I think that you probably want to make sure that the advisors you're working with in all fronts, whether it's financial, legal, tax, have experience in the business. They've been doing this for a long time. They've seen a lot, and they have a deep level of knowledge through either their credentials as well as the years of experience. It doesn't mean that the brand new advisor that is just brilliant isn't going to be able to do the job. It's just less likely. So these are the things that when you're doing an advisory review, these are areas that I would say are really important. What I would say to you is this. Great, fiduciary duty, check. Fee only, check. Been around the business for 40 years, check. I can't understand a thing the person's telling me. I have no idea what's going on. They keep talking about things, they're using phrases that mean nothing to me. I keep asking them, what does that mean? And what I get back is more gobbledygook. So you have a choice. I'm going to trust this person based on the other criteria in my life and maybe even the performance of my portfolio. Or I'm going to demand that I have to have someone who can communicate with me because I want everything to be checked off. So I put communication on top for a reason. Now, investment review, your portfolio review, very, very quickly I will say that it is, I've mentioned it before, a reset of your financial plan. This is a moment in your life, once you reach that point where you can make these executive level decisions in your mind, you're emotionally prepared, this is about you, no longer about us as a couple, as I said. So resetting the financial plan, looking at your asset allocation in your investment portfolio. It's the most important driver of your investment returns. It's the risk. Generally speaking, it's the largest element of the risks you're taking in your investment portfolio. And I want you to know that the risks you were taking, the investments you did have prior to the death of a spouse, may have worked just fine for that situation at that time. Post the death of your spouse, in your new world with your reset plan, those exact investment decisions that you made before may not apply going forward. You have to recognize, I believe, you have to recognize that now is a moment for me to look at even my asset allocation as something that I want to reset. Because now it's you. You're the one that's sitting in that seat as the lead if you weren't before. If you were a part of the decision, asset allocation is probably not going to change a lot if you were part of that prior to the passing. Investment costs, super fast. I would say that not only are you paying your advisor something if you're working on a fee only, basis, or you're paying a commission, or however you're paying them. But there are costs within your investments that you should just be aware of. Mutual funds, the types of mutual funds you're in. The companies that manage the mutual funds charge different fees. Those fees you don't get an invoice. It's just every single day it's subtracted from your investment. Now, the investments supposedly over time go up, but your fee is being taken out of that value. Doing an evaluation of the investment costs in your portfolio is something, it's bread and butter for every advisor to be able to do it. You should just be aware of what you're actually paying in the totality of your investment portfolio. So this is the portfolio review I'm talking about. Financial plan, asset allocation, investment costs. Real simple stuff. Okay, I'm going to wrap up with something that's relatively new in this world. It's not something that if I gave this talk when I was 20 years old in 1992, which would have been hilarious for me to be giving this talk when I was 20 years old. But I wouldn't have mentioned this stuff. And it's your digital life. And it's something that I think more and more people struggle with not only when they lose a spouse, but also when their parents pass away. Because I know there are some people in this audience who are anticipating this. So this is a chance for you prior to the event, or even, well, really preferably prior, to be able to start writing down passwords, PINs, online accounts, brokerage accounts that you're only getting e-statements for, all going into an email account that has a password that's on your phone, that has a 6-digit code to get into when it locks every 5 seconds, okay? That is connected to an Apple ID that only one of the two of you controls, and the notification for the PIN number comes through a text message on the phone that you can't unlock. And we all know that Apple won't unlock the phone for you because they wouldn't unlock the phone for the FBI either. So this is important for you to begin to write down an inventory of your digital life. Everybody struggles with passwords. What I don't want you to do is write it down and put it on, of course, I'm being facetious, but putting it up on the refrigerator. But you need to have a place that you're putting it where only your spouse really knows what's going on. It's something that it feels like is going to be safe. Locking it away in a safe deposit box, and I'm realizing, gosh, I just had my Schwab account. I wrote down the password. I locked it up in the safe deposit box, and now I changed the password. Oh, God, I have to go to the bank. I mean, they're not going to do that. You need to have some system, though, that makes it so that your loved ones, when you pass away, aren't going to struggle with some of the most basic things. And I will say that I put a bunch of social media icons on there for a reason. I didn't realize this existed until I started researching it. And I've seen it personally, and I'm sure you all have too. Someone passes away and they have a Facebook page, and they keep showing up with friend requests. And of course, it's hurtful. At some point, you feel bad every time you see this because you've just lost a loved one, and here they are showing up on Facebook, and Facebook is acting like they're still living. You can actually set up in a Facebook page the ability to have a memorial page. Memorialize that Facebook profile and establish a legacy contact within your Facebook page to make it so that your kids or your spouse can actually take over that Facebook profile and allow people to make comments and share stories, and also eventually be able to shut down the profile when the time comes. So I think that we're all moving to the point where our digital life is starting to, we're starting to get tools that replicate what we do in our physical life. But this is an important thing to do, and I think it's a loving thing to do, to think through what am I leaving behind in my wake digitally for my spouse. So I would encourage you all to think this through in some way or another. Email is a major connector to a lot of things. So having someone have access to your email account will allow for quite a lot of unlocking of things that ultimately do get locked. So with that, I want to thank everybody for coming, and of course I want to thank the partnership with the library and Leland Township Library and also the Senior Center and Up North Media. Because the Money Series, to me, I've been doing this now quite a long time, and the longer I do it, the more I really love it. So I'm glad that you're all here learning something, and I hope this was a helpful program today. Now.